when we talk about the risk premium, that's what the market is building into a risk premium on housing, but there haven't been defaults or haven't been foreclosures. So it's
Exactly. We just
what
I,
WTF.
so why is there a risk premium? Is it people who got it wrong and expected a recession? Well, then as they revise their expectations, because newsflash, we didn't have a recession in 2023. All y'all been telling me every year, oh yeah, next year we're going to have a recession. And then next year comes up, oh yeah, next year we're going to have a recession. And there's still guys out there right now going, Darren's bombarents, next year we're going to have a recession. I'm like, why is anybody listening to you people? Why isn't that risk premium abating as we update to the reality that we didn't have a recession, that things are going, we've got full employment, we're headed back to low inflation. It's like all good unless you live in Hawaii. And
Market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
Hello and welcome to the Hawaii Housing Report. I'm Patrick ONeill, principal broker, owner of Luxury Homes International. And with me today, Hawaii's favorite, and may I say coolest dressed economist, Mr. Paul Brewbaker. How's it going, Paul?
Mele Kalikimaka, I'm just hiding my bed hair. I haven't cleaned up for a while.
All right. Well, it's great to see you. Last month, we did not do the report, and thank you for everyone that reached out. Appreciate the support, but this hopefully will get you back in line and with what's happening. Paul, let's start with the economy and what's happening, and let's start with Hawaii. So the UHERO forecast was just released. They're predicting slower growth for 2024 for Hawaii. What is your take on that? And do you think there will be slow growth 2024?
Yeah, that's fair. I mean, slow growth has been my expectation. My sense is that UHERO and DBED, who have revised down a little bit from what their expectation had been previously, are taking into account the impact of the Lahaina and other Maui wildfires on tourism. But that's really, it's not just a metaphor. I mean, that's really a driver for the state's economic recovery in the post-pandemic era. Itself. I mean, it's of substantial, materiality. It's 30% of Maui's economy, and it's 15 or 20% of the state's economy. Tourism is. So when you
I
have
think
a
that
pattern like this,
Yeah, that was
yeah,
one of
you
the main points that
clearly.
UHERO covered, the deceleration in visitor count, and to a big extent, markets like the Japanese. Sorry to interrupt.
No, that's exactly it. That 150 high interest rates in the U.S. persisting through the year and continuing, um, although abating in 2024, mean a strong dollar, 150 yen per dollar, which makes dollar-denominated real estate assets very expensive in yen and makes the destination an expensive destination for travelers coming from Japan and with incomes in yen. So the Japanese travel portion of the post-pandemic recovery has all but failed to materialize. It's just not there. Now, the rooms can be filled by tourists from other places, right? And we did have a relatively strong recovery in domestic travel initially, punctuated. You see here the passenger counts, which are published on a daily basis, but I've aggregated to weekly data. So these are the data, and I've this I don't have the indication here, but I believe this is through December 7th, 2023. So it's a very, a very timely, very current indicator. And you can see how flat it is relative to the path Hawaii was on in the 20 teens. And as I say, that's both a metaphor for the state as a whole, which has never quite gotten back to its pre-pandemic path in general, but in tourism specifically, notwithstanding the revenge travel surge that did occur in 2022, but faded pretty hard. And there you can clearly see that last vertical band where the wildfires have impaired travel statewide, even though some travelers, redirected their interest to places like Hawaii and the Big Island.
I see. So you'd agree with their projection of slower growth for 2024 based on what you've just shown.
So I haven't seen their numbers, and we have to
Okay.
be careful about an adjective like slower, because
Ah,
slower compared to this year, because this was not a great year, slower compared to what you expected for next year,
I see.
which
Okay.
in my opinion was maybe a little previously. The people who published forecasts at the state and at the University of Hawaii
Hmm.
were possibly a little too enthusiastic, but I think we've all had to temper our enthusiasm about the pace of economic recovery in
Yes.
light of recent events, but also in light of the general sort of underperformance of Hawaii as a regional economy.
Yes. Okay. Let's shift this now and go more of a macro U.S. view. At the
Mm,
last Fed meeting, for the third consecutive time, they've left rates unchanged, and in fact started hinting towards potential rate cuts.
right.
Questions for you. What is your view of the overall health of the U.S. economy, and do you think that the Fed has achieved this lofty goal of a soft landing?
Yeah, well, let's work backwards. It's not a lofty goal, it's the goal. I mean, the idea is for us to modulate inflation without creating any untoward impacts on the real side of the economy in terms of employment, in terms of economic activity generally. Um, Given that we know some parts of the economy, particularly housing, are going to see a decline in economic activity because of the high interest rates. So it's this sort of dance that the Fed was trying to do with the macroeconomy, where the economic recovery has nationwide has been relatively robust, and by raising interest rates and using quantitative tightening, right, reducing their asset purchases by giving forward guidance about their expectation of the path for the policy interest rate, the Fed funds rate, as well as economic conditions and inflation in particular, and interest rates more generally. That forward guidance, the quantitative tightening, the increase in the overnight rate, all combined to dampen investment activity and housing investment activity in particular, against this other backdrop of strength in parts of the economy that are still sailing the tailwind from the fiscal stimuli a couple of years ago, or they are enjoying the sudden appearance and emergence of new economic opportunity, say in e-commerce, which was given a jolt upward by the pandemic, or in, say, this emerging AI space where a lot of capital is flowing and a lot of stuff is going on that nobody quite understands. So, yes, by sort of, unfortunately, at the expense of real estate, tempering a little bit of the economic activity on the real side of the economy, which has an underlying forward momentum that's quite strong, the Fed was able to bring the inflation rate back down. And when you look at it in retrospect, here are the CPI data. When you look at it in retrospect, I mean, it's literally an inverted V-shaped path for inflation, right? After the last stimulus package, as the pandemic recovery emerged in the latter half of 2021, you see inflation surge. It takes a step up when Russia invades Ukraine and roils global petroleum and natural gas markets, as well as agricultural commodity markets, and in the context of a global supply chain hiccup, which which has settled out now. And as all those factors abated and the Fed's policy posture took hold, primarily in real estate, the inflation rate has come down. And this is
So,
so you don't want to
yeah,
stick the landing. You know what I mean? It's like landing a plane. You come down from
right.
36,000 feet
It's
pretty
a
fast,
difficult
and then
thing to do, and there's been many times
getting
in
the
the past where
landing.
that
That's
has
exactly,
not happened, right?
exactly.
So,
Yeah.
so from your perspective, from what you know, you think we are experiencing or will experience a soft landing, not a full-on recession of some
Yeah.
devastating sort in 2024.
Yeah. 2022, when the Fed began raising rates, 2023 and 2024 are the soft landing scenario that the Fed also engineered back in 1994, 1995, 1996. So It cooled down an economy in the mid-90s that was national economy in the mid-90s that was at risk of inflating excessively, and set the stage in the second half of the 1990s, which at that time was the longest expansion in U.S. history, for the sort of the dot-com wave. And where, it turned out the longest expansion, that record was beaten in the 20-teens
Right.
and might have continued if it weren't for the pandemic. But
Yeah.
now we're on the threshold in the 2020s of this really interesting analog, which is the AI wave, that
Yeah.
to me feels a lot like the introduction of internet in the mid
Yeah.
1990s.
That makes sense. Well, let's keep this going in the economy, but let's get to the important one that we care about on the
Yeah,
real estate report
yeah,
is the mortgage interest rate.
right.
And let's bring in Anders Hostelli, Senior Vice President at Guaranteed Rate here in Hawaii.
Hey
Anders, how
guys,
are you? Yeah, good to
good.
see
How
you
you
again.
doing?
Happy
All
holidays.
right, we're doing good.
I will
Anders,
step off.
okay, all right, Anders.
Yeah.
And we talked about this earlier. It was only 2 months ago in October, interest rates were right knocking on the door at 8%.
hmm
Where are we today on your vanilla 30-year fixed rate?
So I use the same scenario, kind of a $750,000 loan with a, kind of a 25% down payment. We are actually looking at under 6.5%. So boy, we really rates have really moved down from those highs back in October. And yeah, I mean, it's looking really good. The other thing is, Patrick, did we always talk about conforming or conventional rates,
Yes.
but government loans such as VA to veterans or FHA loans more for like first-time home buyers, maybe a little weaker credit scores with low down payments. Those rates they're in the high fives now.
Wow.
Yeah, they're in the high fives. So that's we're starting to talk about, I mean, that'll help with obviously affordability. We haven't really seen well, I haven't seen, I should say, a big uptick in mortgage applications, and even the national statistics show just a slight uptick in refinance transactions. But
Yes.
we're right before Christmas, and typically, even if rates are very, very low during the holidays, you don't see as much activity. But I suspect we'll see in January more refinance transactions, and of course, I'm hoping, and we're going to see more purchase transactions because of the lower interest rates.
Okay, so 30-year fixed vanilla one that we've talked about, that right now is around 6.5.
Yeah, it's around 6.5 or a little under 6.5.
And the VA FHA,
It's about 5.75, 5.875. Yeah,
that is so good to hear. Okay.
yeah, it's nice to
Another
hear.
category, and I know that there's also been a change recently, and this really affects Hawaii, which is the jumbo loan market,
Mhm.
which has been capped, and there is an increase. Can you tell me what has that gone up to, and what are those rates like? Are those similar to the 30-year?
Yeah, so the conforming interest loan amount, the conforming loans for Hawaii, talking about Hawaii, is 1.149. So it's almost 1,150,000. So that is up to that loan amount, you can get a conforming interest rate, rates that we've just been talking about. Anything over that would be jumbo interest rates, where they're just a little bit higher as far as interest rates go right now. But
Okay.
that conforming limit going up that high, that's really positive news for us in Hawaii.
Definitely is. That's really good to hear. And then I know you track all these things. Are you seeing any increase in foreclosures or defaults, anything like
No,
that?
no, yeah,
No?
don't, no. I mean, we have quite a healthy real estate market here, so we just want to see more transactions.
Yes, we do.
Yeah.
Okay. And now I know that you look at loan originations, rate locks, to kind of get a gauge of what's coming in the future. Have you seen any change at all?
Just like I was saying, a little bit more activity. I've seen some refinance transactions, which, yeah, we were hardly seeing any of those for the last few months. So there's a little uptick in that. It seems like we're starting to talk to more buyers, are getting a little more serious about putting in offers and getting pre-approved or updating their pre-approvals with the lower interest rates. So again, positive sign for going into next year.
Okay. And I know this was, kind of mid-year, there was some credit tightening happening primarily at the regional banks. Have you seen any changes in qualification, any tightening?
No, I think the last few months it's been pretty stable.
Okay.
Yeah,
Well, Anders, this is the
great
best
questions.
news that we've had in the last
Yeah, I
week.
know.
I mean,
I
last
know.
year, sorry, in the last year. So really
Yeah.
happy to hear that. Okay, we're going to go to the speed round. Now,
Sure.
these are double points here. Now, we
Huh?
know this is
Okay.
just your opinion. This is not the
Uh-huh.
opinion of guaranteed rate.
Right.
Okay,
Okay,
here we
thanks.
go. Here we go. Will
Uh-huh.
the Fed begin cutting rates in the next 6 months?
Yes,
Will we see rates below 6% in 2024?
absolutely. Yes.
Will we see rates below 5% in 2024?
I don't think so.
All right. Okay, we'll check with the judges and get back to you.
All right.
Uh, Anders, thank you very much. And thank you for sending all the data points throughout the week. It's really helpful. Really, really enjoy seeing all of that.
Appreciate it. Thanks for having me.
Happy holidays.
Bye.
Okay, we're going to take a quick break. Going to come back with economist Paul Brewbaker. I think I found the coolest, most shocking real estate statistics that Paul hasn't even seen yet. So stand by. We're going to be right back with that with the Hawaii Housing Report. Okay, and we're back with economist Paul Brewbaker. And Paul, what did you think about what Anders said about the interest rates, and where do you see these trending?
I mean, it's great. It's finally happening. Frequent viewers may recall that we were saying that for like all of 2023 that rates should be coming down, and they weren't. And of course, part of the problem was that the the risk premium, right? The spread from mortgage rates to a risk-free benchmark like the 10-year US Treasury note yield widened out from about 175 basis points in terms of the historic norm to this gigantic 300 basis point spread that was bigger than during the subprime financial crisis, bigger than during COVID. And Anders and I have been trying to figure out, trying to pay attention to the literature and the professionals communities to understand why that spread existed and persisted. You'll notice I call it the WTF era because I have no idea what's going on. And we still don't really have a good explanation. I mean, generally speaking, we think of these things as risk premia.
Yeah, right.
But the point here is that now that the 10-year Treasury note has come down to about 380 or 390, and the 30-year fixed rate mortgage rate has come down to about 650, maybe, 6 2/3, but 650 is what Anders was saying is this week's model, then we would expect that 300 basis points would narrow over time. And that's the other thing we should be looking for in 2024, even if the Fed doesn't validate the expectation of lower interest rates, which is already showing up at the long end of the curve. The long end is coming in. The Fed's holding the short rate at 5.5. They're saying that they'll begin lowering the short-term interest rates as early as mid-year.
But
And
your point is,
so
even if they don't, if that risk
even if they don't,
premium
that mortgage rate,
decreases, rates will come down.
precisely.
Yeah. And
So
that, when we talk about the risk premium, that's what the market is building into, a risk premium on housing, but there haven't been defaults, there haven't been foreclosures. So it's
exactly, we just
what
Uh,
WTF.
so why is there a risk premium? Is it people who got it wrong and expected a recession? Well, then as they revise their expectations, because newsflash, we didn't have a recession in 2023. All y'all been telling me every year, oh yeah, next year we're going to have a recession. And then next year comes up, oh yeah, next year we're going to have a recession. And there's still guys out there right now going, Darren's bombarance, next year we're going to have a recession. I'm like, why is anybody listening to you people? Why isn't that risk premium abating as we update to the reality that we didn't have a recession, that things are going, we've got full employment, we're headed back to low inflation. It's like all good unless you live in Hawaii, and and where people are leaving the state and have been leaving the state for 7 years. I mean, that's Hawaii is its own private Idaho. The US economy, the US, financial markets, the housing market in general is poised for a comeback year in 2024 and beyond.
Okay, Paul, well, let's shift gears and look at the housing statistics from the Honolulu Board of Realtors. And we'll start this off looking at pricing. And I think you have such an interesting take on the pricing and as it relates to the statistics. So here we go, looking at median pricing, we can see it is down 4.5% year to date for homes compared to last year. If we compare it to 2021 year to date, it's actually up 7.6. And if we look at condos, condos at 516,000, flat compared to year to date 2022, but also up 7.1% compared to 2021. And what we talked about last time, Paul, is although we see statistically price declines, in your opinion, it's actually trending on more of an upward slope.
There was this post-pandemic overshoot in the single-family segment and in particular neighborhoods because of the emergence and durability, persistence of remote work, of working from home, which tended to push housing demand a little further out from the urban core into suburbs and exurbs and Zoom towns. And as a consequence, the data in 2021 and 22 kind of for single family homes kind of overshot. And then with the higher interest rates, they abated. But on the condo side of the Oahu market, we didn't see as much of that gyration. The condos have largely stayed on trend. In fact, if you look at these numbers here, flat to last year, up 7% from 2 years ago for condos, that's kind of like saying, we're on a 3 to 3.5% upward trajectory with compounding.
Yes. Yes. Okay. All right. Well, let's move on to not the most interesting, but a pretty interesting look at the statistics on closed sales. Let's take a look over here. Again, starting off with homes, year to date, closed sales down 27%. If we compare it to 2021, which was a phenomenal year, down almost 43%. And in the condo market, year to date compared to last year, down 28%, compared to 2021, down 35%. Big dramatic numbers. And Paul, this is what I pulled out of this, and I know you have some thoughts on this. We're on track 2023 to be the lowest number of home sales since 1998 and the lowest number of condo sales since 2008. That's pretty dramatic. That's right after the financial crisis. What's your take on this, just as a standalone statistic?
First of all, it does, interest rates still matter for housing. So yeah, 2022 and 2023 would have been great gap years for realtors if you went off and volunteered to do good deeds around the world, and then come back and come back in 2024, get back into the business, because as the rate environment improves, we'll see these sales numbers rebound pretty sharply. And in terms of your these two notable benchmarks, if most people will think back, sometime around 1998 would have been a great time to get back into real estate in Hawaii, because that was sort of when things began to light up, and sort of peaked in the subprime bubble around 2005. Similarly, 2008 would have been a little premature. The recession didn't end in 2000. The recession in 2008 didn't end until the middle part of 2009, and of course it lingered in people's perceptions for at least another year. But the point is that whenever you see this kind of benchmark, the lowest, in whatever, you're probably at or close to the bottom, and you should start thinking about, the upside on the other side of the bottom. That would be a good frame of mind to carry out of 2023, moving into 2024.
Yeah. Well, good advice. Good advice. Okay. Now I'm going to go into what I think is the coolest thing I learned preparing for this. Oh, sorry. No, one more before we get to
that.
Yeah. Another sign of the shifting market. This is sold at or above list price. November 2023, 21% of homes and 19% of condos. Compare this to 2021, when it was 62% of homes and 41% of condos. Clearly a sign of the market shift. Would you agree?
Yeah, I mean, that's a sign of subsidence in the amount of excess energy, right? Excess demand that was in the market a couple of years ago. And surprisingly, because you have to remember, after the pandemic hit, the instinct for a lot of people was to think, wow, we're toast. And in fact, the pandemic itself, by changing the way we work, and then pandemic recovery by giving people a reason to bust a move and optimize, spatially where they were going to live in the post-pandemic future, provided a jolt of energy to the housing market, and in particular on the demand side of the market, helped along by low interest rates, but at a time when supply, new supply can't ever respond that fast. And
Right.
so that's what you're looking at in 2021. Things obviously quieted down with a 7 or 8% mortgage rate in the last year.
Yes. Hey, it's Patrick. If you're enjoying this information, please give us a thumbs up below and subscribe to the channel. Aloha. Okay, well, now let's go to the coolest thing I learned this week in preparing for this active inventory. So I'm going to, some of it is what we see all the time. So compared to last month, we're up slightly compared to November 22. Okay, compared to November 2021, there are 84% more homes on the market right now than there was in 2021. And I've got the numbers down at the bottom there for anyone who wants to check the math. That is pretty dramatic, but there's more, so stand by. Now here's condos. Again, compared to 2021, there are 30% more condos on the market today. Of course, we hear all about the shortage of inventory, and certainly that is true. But let me take us back to 2019 November.
Yeah. I was
Pre-pandemic.
looking at that footnote, wondering if you were going to highlight that.
Okay. And now remember, November 2019, the market is cooling off, right? We're starting to think we're heading into this correction. And then check out these numbers. Inventory last November compared to November of 2019, 50% less inventory. In condos, there's 42% less condos on the market. Isn't that shocking? I mean, it's crazy what a big change that's been.
Well, it just tells you a 7.5%, 8% mortgage sends everybody back into their cave, not just the buyers, but the potential sellers. Like everybody's trapped in their, we used to joke about this. Everybody was trapped in their house with their 3% mortgage that they refied a couple of years ago. But it's also notable because you brought that sort of pre-pandemic benchmark to bear on our thinking here, that an ordinary market is one in which there are 1,500 to 2,000 single-family homes and condos, respectively, out there available for sale. So if that's where we're going from 600 or 700 or whatever the numbers were most recently, that's plenty of business for a lot of realtors.
Yeah. And for buyers, I mean, to get that relief, but
and opportunity for buyers, absolutely.
Yeah, for sure. Okay, well, Paul, it's time for the speed round with you, and we're going to see if you get these right. Okay, here we go. All right. I think I already know your answer to this one. Will the U.S. experience a recession in 2024?
Oh, absolutely. We're toast. No, there could be a recession. What we surely have learned in the last few years is like what Rosanna used to say, right? It's always something. If it's not one thing, it's another. And if you're old enough to remember Rosanna,
I do remember
Rosanna, I'm sorry to hear that because I am old. But I'm just saying, every year we wake up and there's a wildfire or a Russian invasion or turmoil in the Middle East or a pandemic, and these things, these geopolitical and biological and geophysical, volcanic eruption, these things do happen. So with the caveat that for sure something will happen, no, my expectation is that the U.S. economy will continue to play through on the economic expansion that began in the immediately in the latter half of 2020, as we began to think about a post-pandemic.
Okay, so I'm going to summarize your answer as no.
Yes, no. Yes, that is no.
6 months from now, where do you think the 30-year mortgage rate will be? 6 months from now, currently at 6.5%, let's call it.
So my guess is it'll have a 5 handle on it, but it won't go all the way.
Okay. All right.
Yeah, I
6
mean
months.
it's going to
Mhm.
come through 6 and into the 5s.
Okay. 6 months from now, home prices up, down, about the same.
Well, on a seasonally adjusted basis, up a little bit.
Okay. And then 1 year from now, home prices up, down, about the same.
Same smell.
Okay.
Up a little. You know, we're looking at modest appreciation over the next couple of years.
Okay.
3 to 5%. Yeah.
Sounds good. Paul, can't tell you how much I enjoy getting together with you
Oh,
and
it's
getting
fun.
all this information. It's really a
Been a
blast.
great year.
Yeah. And a big thanks to Anders Hostelli from Guaranteed Rate for getting
Absolutely.
involved as well. Yeah, it's really helpful for all that. And by the way, if you're watching this and you've enjoyed it on YouTube, please hit the thumbs up below for Paul. Give him the Christmas present. Subscribe to the channel so you don't miss next month's, which will be the year-end recap. So, Paul, wishing you a big Merry Christmas, Happy New Year, Happy Holidays. Right. And to everyone else, thanks for joining us. Be well, be kind, and aloha.